Welcome back to another Roundtable. My name's Adam. I have Rusmin.
Hello.
And Victor.
Hi everyone.
Thank you once again for joining us. And today we're going to talk about one probably undervalued Hong Kong property developer.
Yep.
So a couple of roundtables back, if you remember, we've been talking about China and its property crisis.
Yes.
And how that has affected China, but also companies in Hong Kong. Which are in the property sector have been dragged down as well. So this company that we're going to talk about today is Hong Kong Land.
Yep.
And so it's dropped about 20% since this most recent property crisis in China.
Yep.
So we're going to find out if there's an opportunity there.
Yeah. But they are listed in Singapore.
It listed in Singapore. And the interesting thing is this Hong Kong Land, that's the name, is actually technically a British company.
Yeah.
Yes.
Listed in Singapore, like you said, and in London as well.
Mm-hmm.
But it's been caught up in this whole China property thing and share prices come down. So we're going to have a look at whether there's an opportunity to have a look at Hong Kong Land. But before we jump into the valuation and stuff like that, it's very important to understand its business model.
Yeah.
So you kind of understand what you're getting into. So why don't you guys start on that?
Yeah. So Hong Kong Land owned a bunch of lands in Hong Kong, as the name suggests. But for the properties that they own in Hong Kong, I think they are largely located in the central MTR area, right? Okay. So if you look at some of the properties like 1 Exchange Square, 2, 3, right? So basically that's under Exchange Square. And then they also own the Forum, Jardine. And by the name itself, this is actually owned by Jardine, right? Mm-hmm. And and of course the Alexander House, Gloucester Tower, and of course the Landmark Prince Building. Okay, so all these properties are prime grade A offices in Hong Kong. Okay. Right, in the central MTR. And if you've been to Hong Kong, if you take let's say you land on the airport, you can take the express train to straight into the Hong Kong Island, and then you can change the train station to the central, right? And that region, if you've been there before, even before COVID or after COVID, right, it's always been very packed.
You've been there, right?
Been there.
Well, I've been there. It's very, very packed. It's very crowded. It's actually the business district. So if you were to look at central in Hong Kong, they call it Zhonghuan, right? That is like the Raffles Place in Hong Kong. The business district. Yeah.
Right.
Yeah, of course they are a lot more crowded there.
A lot more crowded.
You saw
compared to Singapore.
Compared to Singapore, right? Yeah. So those properties are super prime, right? And they have on a bunch of cluster around that MTR, super prime, the prime of the prime, right? So so it's very well connected. It's very convenient, and they got a lot of staffs over there. And of course, if you look at the building, the average building, the age itself, most of them were built in 1980s. And some of them are 1970s. And if you calculate the average age, it's probably going to be around 40 plus today. So by all standard, if you look at building that is 40 plus, generally it looks old, right? But I think when you are there at the central or any one of the properties, they do quite modern, right? Largely because they have been, investing in the hardware, upgrading the hardware, either replacing the escalator, improving the lift, the aircon, and make it ESG compatible, right, friendly for a lot of tenants there, right? So, and I think the most important part of this property is that, besides they are being prime, you also want to find out whether their land tenure with the government that actually give them a land lease period, how long is it, right? Or is it a 99 years lease, or is it a 50 years lease, which some of the properties in Hong Kong could fall under during the handover, right, when they pass it back to China, right, British, and that's actually the figure is very hard to find. Okay. So you have to go and read the annual report. Right? And even the last 10 years annual report, you can't find that figure. You have to stretch back all the way to 2008.
So you found it
that year, and then I found it. And most of their properties that I mentioned early on, they have a lease expiry that comes with 999 years lease. Okay. Which is as good as
freehold.
Right? So, and of course, there are few of them that are going to expire, like Exchange Square in 2057. Okay, that coincide with the 50 years frame. But that they can actually the government allows them to renew for another 75 years. So it's still a long lease, right? So you're not talking about property that have very short land tenure, right? So it's bulk of it is basically freehold.
Okay, so this is different from the 2047 that most Hong Kong properties have.
Yes,
in that sense,
correct.
Right?
So to put into context, if you were to look at, let's say, Maple Tree Pan Asia, they also do recently acquire, Festival Walk, the shopping center. That I think is about 50 years, right?
Yes. Yeah. So essentially, I think you are getting a bunch of like freehold properties in Hong Kong Prime District, and Hong Kong Land basically lease them out, and then they just collect rental income from there. And that has been their crown jewel for Jardine. And of course, on top of that, they also own prime properties in Singapore. Okay, so you have Marina Bay Financial Centre. They own 1/3 of it, and of course, One Raffles Quay also they own about 1/3. And of course, they also own One Raffles Link, right, which is connected to the City Hall MRT station. Nowadays, of course, you can access it through Esplanade MRT station as well. So it's very convenient. That property, they have 100% shareholding over there, right? So just from this investment property alone, and if you look at this segment has been contributing a quite sizable contribution to their bottom line. Okay, so if you look at their revenue by business segment, okay, investment property actually account about 47% as of 2022, right? And then the development properties, which they also do development in China, Singapore, and the rest of the Asian region, they actually account about 53%, okay, half. Okay. This is based on top line. If you go down to the bottom line, okay, I think you are looking at the contribution split of around 70% coming from the leasing income, which is the investment property, and then 30% coming from the development properties.
Got it.
Right. So this is in sharp contrast with those Chinese developer that we talk about, right, that were caught in during this crisis because of the property slowdown, right? And if you look at some of those like China Evergrande, Country Garden, right, Sunac, right, China, their business or operating profit, right, actually above it 80, 90 or even 100% of them come from property development or sales, right? And now this segment is getting a lot of stress during this crisis. That's why a lot of this company got into liquidity issue, and that's the whole talk about real estate China crisis, right? In China, actually have facing a lot of stress there. Okay, but for Hong Kong Land, I think not only they are still holding up very well in terms of development sales, they have declined, right? Of course, on the first half to half basis comparison, it declined about 20%. But if you look at their overall operating profit, 70% of it still come from the leasing income, and the other 30% actually come from development, right?
So they're really just not affected at all because they just have this base of, like you said, prime properties.
Yes,
they're always in demand, and the rental income is always coming in.
Yes, even let's say there's totally no sales for their China side, which I think above their development is actually in China, mainly in Zhongqing, right? And if let's say that market really dries up and then there's no income coming in, they still have that steady leasing income that's giving them very consistent income. All right, and this will be able to allow them to tide through the whole crisis. They won't get into some liquidity issue that we saw with a lot of Chinese developers.
So that was the next question I was going to jump into. I mean, now you kind of understand what the business model of Hong Kong Land is like. A lot of investment properties, very stable revenue from their rent. So it seems like they can ride through this property crisis in China because their exposure is limited. And Hong Kong is still, I mean, it's like crowded as, like you said, it's super crowded.
I mean, it's not gone back to the pre-riot level because now they have just opened up, right? I think this year, and then you started to see tourists going in, and that will picked up, okay? And Chinese tourists are also heading in, but you know, the flights takes time to come back before the full recovery, and you don't know when that's going to happen, probably in the next 3 years.
So if you were to look at Hong Kong Land, they not only have the Hong Kong properties and the Singapore properties, they also have a strong pipeline that's going to come in, the retail pipelines, right? That currently, right, they have about 172,000 square meter in terms of the existing property, but they're going to increase it all the way to 532,000 square meter, right, by 2028. And that comes, right, with the existing property inside, and the increase, right, is from the Chinese mainland retail properties, right? And those will increase their net lettable area by 209%. So there's a potential that they're going to increase their rental income moving forward, which in return, right, will increase the dividends. Right?
So it's about threefold, right? And that will be in 2024. 2023, I think you're already seeing income coming in from some of the retail side in China. And then, of course, Chengdu, Shanghai, Nanjing will start to come in. Right? So they have a few lists of developments that they have laid out, okay, like in the Century Land, Central Avenue, right? So this list will get completed over time, and that will help to bring in more cash flow, because China in the past they have been doing a lot of property development, right? So they have been relying on that, but now they want to build something that is a lot more sustainable than what they have done in Hong Kong. But Hong Kong, above of it is mostly office, right? And then they have Landmark, the retail portion, which is still quite small if you compare with the office side. But in the China, I think they're going to build up that huge recurring income of retail properties that's going to come in.
All right.
Yeah, I think so far, I think those leasing income has allowed them to continue to pay very steady dividends, right? So I think if you look at the dividends, it has been growing steadily. Of course, the last few years, since 2018, it has been very flat. Okay, so talking about that aspect, whether they can maintain the dividends or whether they can withstand this crisis, of course, you get to look at their financial health, right? So I think based on their net gearing, they are still at about mid-teens, right? They're looking at about, I think, 17%.
That's it. And like for REITs, we're comfortable with like 30-40% usually.
Yes, and that's against the asset. Now we are talking about against the equity. Right?
Okay.
But of course, that can be very subjective depending on the investment value of the property itself, right? So, but basically, generally for net gearing, it has been hovering at about teens level. Okay. I mean, in the past, it used to below 10% when the interest rate was very low in 2014, 2015, 2016, right? But that has crept up, okay? And that largely also because now they are investing a lot more in China to build up all these property developments, and then eventually they will keep some of the those investment property that they have in their umbrella to collect rental income, and then the development side they will continue to do it, but then that will continue to recycle and then buy land. That will be their under property development side, okay? And interest coverage, I think, has been always above 10 for the last 10 over years, and recently has come down because of the higher interest rate that we are actually seeing now I think at about 6 times. So interest coverage, I think as long as above 3 times is considered quite reasonable, quite conservative, right? So as you go above 5, maybe it's even more conservative. But this is expected to come down because of the higher rate that we are seeing in Hong Kong itself. Okay, and of course, besides that, you look at the average debt tenure of the loan that they have is about 5.7 years. So it's very well spread out. You don't really have the risk where they have liquidity issue. Okay. When they have cash flow coming in every year, right? And then on top of that, they have liquidity excess of about 3 over billion, right? So and half of their debt are actually fixed. So that will help them to offset some of the a lot of pressure that they are seeing in the current high rate environment.
Okay.
Yeah.
All right. So it looks like it's a very conservatively run company in a sense. They have this model that they want to replicate across different areas in different countries. Yep. And they just kind of focus on investment properties. Yep. And they have that recurring rental income.
Yes.
Looks like their model. So I think someone could look at this and go like, hey, it's something that I like, kind of like. It's predictable. Yeah. Pays a dividend. It's pretty stable. Any risks that, I mean, look, it sounds really good, but I think at the same time, what's some of the risks that someone could consider as well?
I think if you look at the bulk of the portfolio, right? So I talk about their operating income having 70% come from investment property, right? And within that 70% of the operating profit, right, which come from investment property, about 80% of the investment property actually comes under Hong Kong and Macau, right? So if you look at Hong Kong and Macau, the property market, especially the office segment, has been facing a lot of stress, including the retail, since the riot broke out in the second half of 2019. Okay. So that segment has been a big drag. That could have been just a temporary drag. Okay. But then subsequently 2020, we saw pandemic, and then Hong Kong, China got into lockdown, and then there's no tourists going in for the next 3 years. And only until recently then we saw that it opens up again and tourists are going in. So because of that, the tough second half 2019, 2020, 2021, 2022, look at the leases that they signed and renewed, right, in the subsequent for the last 3 years has been negative rent reversion, right? Because rent has come down, and because of that, you look at the average net rent. It actually peaked in the first half of 2020 for their Hong Kong office portfolio, right? So at about $120 US dollars per square foot, and that has come down, all right, to about close to 108, 09, that region, and it's expected to come down, because those leases that they signed in 2015, 2016, right, were started to get suffered or affected, and that caused the net rent average net rent per square foot start to come down, right? And again, there will be a lagging effect because usually when you sign a leases, right, there will be like 3-4 years, right? And then when the renewal comes, and then the market rent is now a lot softer as compared to the 4 years ago, which I think it peaks about 2019, right, before the riot came, and then subsequently the whole market just doubled. So that's why you're seeing a lot of stress for their Hong Kong office portfolio, but it's not a sharp fall, right? It's going to be like chip off in the low single digit decline over time. And vacancy rate in, I think, Hong Kong office prime area for their portfolio is actually it's been risen to all-time high actually for the last 6-7 years at about, I think, hovering about 7%. Okay, so but if you look at the industry-wide office Hong Kong, I think now recently I think we saw the report by JLL, the office vacancy rate is about 15%, right, in the prime grade A office in the Hong Kong market, right? But within the central region, I think they are looking at about high single-digit vacancy rate, right? So that will continue to put pressure on the rent because of the slowdown in China, macro level, right? So you don't know when that is going to recover. And of course, if recover quickly, the government can steer it around, then that could be the bottom. All right, but if not, the next renewal for the next 2 to 3 years will continue to come down because of the pressure that you're looking at.
And there's that concentration risk as well, because it's a lot of it in Hong Kong.
Yeah, I don't see it as a concentration risk because the Hong Kong central portfolio, the offices in the NR area, is tightly controlled by the Hong Kong developers like your Chong Kong, your Song Hong Kai, right? And then of course the New World, right? And all these very rich cash cow, right? Asset, there are a lot of those rich Hong Kong tycoon actually own them, and there's not a lot of transaction. Okay, so as long as there's not a lot of transaction, usually it's very tightly controlled. You don't see the valuation of this property come down like 20-30% immediately because of a lot of distressed seller, right? And all these guys no need because they are cash cow.
Okay, but that depends on, as long as Hong Kong properties in demand, the people still want to be there, do business there and rent there.
Correct.
So Hong Kong's status must be remain as it is in a way.
Right. So there's a long-term threat to what we are seeing, of course, in Hong Kong, right? But with economy that opens up recently, I think that will continue to trigger the recovery coming in. It's just that the leasing demand will be weak because of the uncertainties that we are seeing across the market, and higher vacancy rate now you are actually experiencing in China, in Hong Kong. And of course, the supply also going to come in. They say there's about, I think, 10 million of square feet of office space going to kick in Hong Kong, right? So, but actually out of which only 1.1 million will be in the central region, which will affect their Hong Kong land properties. Okay, so it's only an increment of about 4.6%, but that will only happen in like 2027. The next 4 years, right? So it won't be a sharp decline, like I said, right? So you will start to continue a decline in net rent per square foot, due to the delay of effect. Some of these leases that expired, which they signed at a higher rental rate versus now, right? So that will likely going to continue. Because of this, that's why you see their net asset value is coming down because of the lower property valuation across the board. And of course lower rent plus the expansion of cap rate, which is a property valuation, has expanded, has come down. So someone looking at this, they kind of understand the pros of his business model and the risks that you just outlined. How would they value a stock like Hong Kong land? How would they go about doing it, and is it undervalued at this point in time?
Okay, so if you look at Hong Kong land right now, right, I have a chart over here. I think because it's a asset-based stock company, we should actually value them based on price to book, right? So if you were to look at the price to book chart that I plot over here since 1996 all the way till now, right, the average price to book is around 0.66 times, right? So right now they are traded around 0.224-225, right? They are actually at the level of Asian financial crisis right now, right? So it's a very cheap valuation at current price about $3.60 plus, so 22 cents of dividends. So that's about 6.6 to 6.1% dividend yield you're getting, right? Waiting down there for the recovery while getting paid, right? So you can see from the chart, there's only 3 instances, right, where they drop like below 1 standard deviation, right? So that is in 97, 08, and right now. So,
and of course, 2020 COVID, right? So
2020 COVID,
the sales now you are essentially back to the peak of the COVID lockdown level, right, in terms of share price and in terms of price to book.
So if let's say I want to be very conservative, based on the first half 2023 results, I have a table over here. Let's say I were to take the cash the investment properties, the associate and joint venture, which is also property that they do associate and joint venture, property for sales, which is their development, right? I add them all up, right? So let's say the cash is 100%, but whereas the investment properties, the asset and joint venture and property for sales, right, I discount by 45%. Okay, why I'm discounting for 45% is because if you were to look at the ancient financial crisis, right, their book value actually dropped about 42%. So I want to be conservative. I make it round up to 45%. So discounting 45%, which means that you left with 55% of the value. So you add up the total plus the cash, right? That will give you about 22.7 billion in terms of discounted asset. I exclude all the receivables and whatever inventory that you have. I don't care.
It's hard assets.
Yes.
Right? Yeah, okay.
I minus off their total liability, everything in the bank loan, which is about 9 billion. Right? So that gives me a net discounted amount of about 13.7 billion. And you divide it by the outstanding shares that they have. So that is your discounted book value is actually $6.12. And right now they are at $3.60 something cents. Right? So it's significant discount from sort of like a liquidation value. Right? And you are being paid 6%. To wait for recovery. This is the first thing. And second is that the management actually do very sound capital allocation, because the management already knows that the business is undervalued. And if you go and look at all those Jardine, right, because they're owned by the Jardine, the K-Sweet family, their track record, right? You will realize that they tend to buy back shares when the companies is undervalued. So right now, based on the book value and based on the yield, right, you can see generally this company is very undervalued. But in September 2021, right, they actually announced that they're going to spend $500 million US dollar to acquire the shares. Okay, then on top of that, in July 2022, they top up another $500 million. So that will account about $1 billion US dollar. And at the point of time, the two announcements, right, their share price market cap was about 10 billion plus, slightly out a bit. So they are reducing 10% of the share counts.
If all fully deployed by the end of the year.
Yeah. So right now they only left with 401 million. They already deployed the rest already. Right. And they're going to and you can see from their report every day, right? They are acquiring every single day. They're going to acquire all the way until the end of the year, which is going to be 1 billion US dollar. And now the market cap already dropped to about 8 billion. So based on that, right, you can roughly know that they don't reduce about 10%, slightly more than 10%, because the market cap have fallen. So when they announced at the point of time, right, the number of shares they have is about 2,333.9 million shares, right? So right now, the latest figure is about 2,212 million shares. So they reduced about 5+% shares already, right? They bought back about 121.9 million shares over the market. So all this, right, is actually, I think, very sound. This is the first thing, because they buy back at undervalue. Second is that when the share count reduce, right, let's say they were to maintain the same amount of dividend payout, your dividend per share is going to be higher. Okay, but then the management still maintain the 22 cents payout, right? Even though they paid the 22 cents payout, right, it's still significant less than the underlying recurring profits that they have. So they have buffer in case anything happens, right? They still can maintain buffer. It's about, I think now it's about 64%. So anything happens, right, they are still able to maintain the dividends, right?
So the way they allocate capital is that they're going to prioritize their investment projects, right? If they can give them higher ROI, they will put the money there, right? If then after that, subsequently, the second policy is that they will look at the dividend. They'll try to make sure and grow the dividends, okay? And the third, of course, is the buyback. And now they have used that buyback to actually buy back share, which is good, because at current market condition, it's really the right time for them to buy back in an aggressive manner, because that will help to reduce the share count. And hopefully by 10% or more. Right?
So if you were to look at the situation of Hong Kong Land, right, they are sort of like in the property down cycle, right? And because they are the property down cycle and they have the recurring profits, right, and the yield they have, and they traded at very low price to book, it seems like a bargain. Okay, if you believe in the property cycle, that means you believe that the property is go up and down and eventually will come back. Okay, but if you are someone who don't believe in property cycle, you believe that the property in Hong Kong is going to go to zero, or you believe that China is going to take over Hong Kong and take away their Hong Kong and Singapore property, then avoid this company at all costs, right? So that's my take on Hong Kong Land as a whole. If you believe in property cycles,
okay. Of course, there are some green shoot for their recovery part, right? So you look at their Hong Kong retail, actually the net rent is going to come up. Because they were the first to get hit when the protests kicks in 2019, and then subsequently COVID, and that average net rent actually dropped quite a lot, right? But I think for the last 3 years, you get to see that actually coming up very nicely. The second half of 2023, you see that could continue to grow, right? So that is one green shoot. And of course, recently, I think we saw a lot of news that announced by Chinese government to actually relax the rules on owning properties in China, because they want to drive back the demand, right? So they cut down the mortgage rate, even for the existing those people who borrow money to buy property. They have already had existing contract with the bank, and then they tell the bank that, hey, look, you have to bring down the rate for these people.
Okay.
So I mean, if I'm a bank, I own bank share, it's kind of like sucks, right? Because now I have people that pay me with lower interest rate, even though they have agreed to pay me at a higher rate in the past, right? But because of this policy, they have to do it. But that will allow the property investor to have more leeway to do their cash for other things, right? And on top of that, the down payment for, I think, Chinese used to be like 40% if you're a first timer, right? And now that has been cut down to about 20%. In some state, of course, it's 30%. And of course, second purchase that you have, I think the down payment now has been reduced to 30%. It used to be like as high as 80% if you're buying second time property, right?
Okay.
So those are the rules that they have relaxed, and that, of course, will take time to play out, right? It usually take about a year, right, before you start to see all these things.
I think if you were to look back in China's currently the situation, then you look back into like all those property downtime during the Singapore market, right? Then you realize that actually there's sort of a similarity at that point of time where Singapore property is very down, right? What I used to heard of this phrase is the best time to buy into a property is when the government relax the rule, because nobody want to buy, and that's where everything is in the bargain. And if you go and look at all those property crises of Singapore, right, during the very bottom, they relax the rule.
Yeah, actually, if you look at the property development side in China, they're actually doing okay. They're still profitable.
Right.
And because their focus is on the premium residential market in China, and mostly, of course, like what you saw in, like, for example, in Singapore, they have those Tembusu Grand. I think that has been well received by the market, Park Asta. But in China, they also focus on the premium tier, right? And
all these are by Hong Kong land.
And that market, I think, for the China development side, is also doing quite well. Although the sales come down because of the macro events that, and also the timing of completion of the project, right? The sales will only recognize as the time goes by, right? So technically speaking, I think they are not as badly affected compared to those that Chinese developer that you saw with like Country Garden or even you know, Evergrande.
But their share price are affected.
Their share price were affected because of that. Okay, so I think generally they should do okay. They will come out even stronger as over time, because as they have more leasing income coming from China side, they have two anchor, right? Not just from Hong Kong. They're also building up Singapore side. Okay, and then of course now you have China leasing income that's going to come in to help them to grow in the future, right? So this company, I think, has been like, you know, paying you dividends and then reinvest about the money to buy more land, build, right, and then build more cash cow. So they have been doing this for the last 30, 40, 50 since the British Empire, the Jardine, right? So they will continue to do this, right? So this crisis is not going to
I would say it's not new to them also.
It's not new to them.
So they've been through many cycles.
Crises. And you are talking about many generation of Caswick family that have actually passed down, right? It's one of those most successful family business that has been around, right, in our generation.
So one thing we also need to take note is that sometimes, right, even like now may seem as a bargain, but if a lot of bad news would come down, even though they are bargain right now, it can go even more bargain. Right. So as an investor, right, we must know that at the end of the day, do we still collect a dividend? Is it sustainable? It's okay that, you know, you are being paid to wait for the recovery. Right. You get more panic if there's no dividend coming in, right? So if you were to look at let's say currently now their book value is about $14.47 right, US dollar, right? So like I told you, they're going to drop book value actually drop about 42%, right? Let's say 45%. So 14.47 you multiply by 55%, which is about 45% of drop, right? That is going to work out about $7.96, right? So that is the book value after the drop. And if you were to look at their track record, the lowest PB that they have gone to, right, is about 0.21 time.
Okay.
So 0.21 time or $7.96, right? It's going to be $1.67. So there's a probability that the company will continue to drop if the macroeconomics get very, very bad, right? But as an investor, you must know that do you believe that the property cycle will come back, right? So it's just an opportunity and how you see it. But some people, they may panic.
I think there are two different things. One is the business.
Yeah.
The other one is the share price. It could go lower.
Yeah.
And some people will just can't.
Yeah.
Yes.
Because the price and the business in short term don't relate, right?
Yeah.
But over a long term, like Warren Buffett said, it's like a weighing machine. They weigh the right thing, right?
Yeah. And of course, this thing is not over yet. I mean, the bad news. Because if you look at their first half result, you saw that they have actually reported a loss about close to 333 million. Mm-hmm. Right, so you may thought that, hey, this guy is losing money. How come we thought that they have a lot of cash cow, stuff like that. But okay, you got to take note that there's actually fair value losses that actually part of it due to the fact that their Hong Kong properties valuation dropped by 2%. Okay, and that is enough to trigger it because such a big value, and that actually is enough to trigger the whole income statement become a loss making. If you take that out, actually they are still very, very profitable. Right, they probably declined by 1% or relatively flat. Yeah, so that's why
paper losses.
Yeah, it's just a paper loss. You don't need to worry. But second half of 2023, you will see a paper loss again because of that across the board valuation that has declined, and also the rental income for office market has been quite weak.
Okay. So you have to focus on their underlying recurring profits that they have been showing. Right.
Yeah. So that is more like a look through.
That is the true litmus test of this business.
Yes. Yeah. Right. So, and of course, I mean, we may be like very positive about Hong Kong land. You got to bear in mind that these are just for sharing, right? It's not a recommendation to buy or sell. Okay, please do your home due diligence first before you do anything. It's just that we want to give you guys an example of Hong Kong property developers that got affected by the recent sell down since the last video that a lot of you asked, what company is that?
Yeah, and there were a few comments as well that, hey, how about Hong Kong land? I think some of our viewers actually are quite savvy. Yeah. And they were like, hey, how about Hong Kong land?
So, and of course, we also have to declare our interest, right? At this stage, I have no interest in this company. Okay. Victor, I
bought it for my aunt.
Okay, I don't have shares in Hong Kong land as well.
So we just want to put this up front, okay? But it's just to give you an example that, in every crisis, there are companies that are actually shining, right? And you just need to go there and choose and find them, select them.
Look through all the trash and, there you go. I actually found my Bitcoin hard drive in the trash. Something like that,
But you have to size your position, right?
You size your position.
You're not going all in. I'm not asking
you to sell my house to go and find the
sell my house. Take up margin loans and go and don't do that, okay? Because anything can happen. That's what I'm trying to tell you, is that the price now is like that. It may still go down because of all the bad news, but it does not equate to the business. But if you were to take on margin and you all in on this company, then you're going to get margin call. Right? Do not take such risks. Right?
All right. So I think, again, no recommendation to buy or sell anything. We're just sharing our research and how we do it so that you guys kind of know how to go about analyzing a company like that. And then, of course, you go back and do your own homework as well. Take a look at the annual reports and the financials, whether it sits with you and whether it's something that it's part of your portfolio that you want to include, because it's different for everyone. So I think this is a very comprehensive breakdown case study of Hong Kong.
I mean, there are many more we can talk about, right? So it's going to drag on.
It's going to drag on. This can be hours of teaching about one particular company like that. So I hope this was very, very comprehensive for those who are actually looking into companies like that, and you're into, basically doing research and analyzing companies. This is what we do every single day when we are doing our research for our stocks as well. So this is what we do. So we just want to share a snippet of that with you, and I hope that was very, very useful. Is there anything else that you want to share, guys?
Yeah, I think if you're looking at this, of course, this is in US dollars, so there's also a currency risk that you need to bear in mind, right? So that's the last thing that I want to say.
Okay, good. All right, so with that, my name is Adam Rusmin.
Thank you.
Victor, thank you so much for joining us. If you have any questions about Hong Kong land you want to ask, put them in the comment section. If you like this roundtable, put them in please hit the like button, tell us you're doing a great job about this, and of course subscribe to our channel. Many more roundtables come up, and we'll see you again.